Mhm. Now we'll be discussing the mock test paper scheduled on 25th of August 2019. First of all, the multiple choice questions. First question was compute the tax liability of Mr. X from the information. The information was provided to you and where we have to compute the tax liability. Here, salary income and the income from house property, they are chargeable to normal slab rate. LTCG 5 lakh rupees was there. In excess of rupees 1 lakh, the same is chargeable to tax at rate of 10%. Short-term capital gains, they are chargeable to tax at rate of 15%. And unexplained cash credits of rupees 5 lakhs. The same are taxable at under section 115 BBE at rate of 60% increased by 25% surcharge. So the effective rate is 75%. So liability will be this 3,75,000 will be on unexplained cash credits. 225 they will be same will be chargeable at rate of 15% here, and LTCG will be taxable in excess of 1 lakh rupees, 4 lakhs on 10% rate, and slab rate is applicable. Then it is to be increased by HEC, and effective rate will be effective tax liability will be what 5,52,500. And question number second was Mr. X is a NOR, and you are required to compute his income. So in case of not ordinarily resident, professional income is from Singapore, branch received in Singapore, profession was set up in India. Since the profession is set up in India, it will be what? Taxable here. It will be taxable. 15,000 will be taxable. Then profits from business in Delhi but managed directly from Malaysia, income is accrue or arise in India, therefore the same will be taxable. Rent computed from property in Malaysia, deposited in Malaysian bank, and subsequently remitted won't be taxable in case of NOR. So his total income here will be 55,000 rupees. Then the next question is relating to salary, gratuity received by a employee other than a employee which is covered under Gratuity Act. As you are aware that the exemption limit has been enhanced to rupees 20 lakhs. So in this case, the exemption limit is now 20 lakhs. He is drawing salary. He has received gratuity of 38 lakh rupees, and completed years of service is 25 years, and his basic salary is 80,000, and DNS allowance is 25,000. DNS allowance is 25,000. 40% forms part of retirement benefits. So his salary for the purpose of gratuity will be 80,000 and 10,000. That is what DA to the extent it forms part of retirement benefit, 90,000 it is. So here the gratuity received is 38 lakh rupees. Exemption is half month's average salary for every completed year of service. That is 11 lakh 25,000 rupees, or the amount which has been notified by the government, that is 20 lakh rupees. Whichever is less will be exempt. Hence taxable gratuity they are asking for. So gratuity exempt will be 11 lakh 25,000 rupees. Gratuity exempt is 11 lakh 25,000 rupees in such a case. Then Prem owns a house in Madras. During the previous year, 1819, two-thirds of the house was self-occupied. In case of self-occupied property, annual value will be nil and only one deduction, interest on borrowed capital, is allowed. And the other one is how there is one-third portion has been let out. Monthly rent is 8,000 per month. So the rent will be municipal value of entire house is 3 lakh. So for one-third portion it will be 1 lakh. Fair rent is 90,000. Standard rent is 1 lakh 10,000. So here we will be getting the gross annual value, that is municipal value or fair rent subject to maximum standard rent. If ARR, if it exceeds ARR, then the municipal value or fair rent, that is expected rent, will become the gross annual value here. And less whatever the municipal taxes paid, 10% of the municipal value has been the municipal taxes paid, the same will be allowed as deduction, and 30% will be on account of statutory deduction, and interest on borrowed capital. Interest on borrowed capital is here 1,20,000 is a borrowed capital. So here interest will be one-third of that same will be allowed here, and remaining two-third will be allowed in respect of the self-occupied portion. So the total income from house property in such a case works out to be loss of rupees 57,000 loss is there. So the answer will be in this regard. Then here, next question is Mr. M took a loan of 6 lakhs from 1416 for construction of the house. The loan carries an interest of 10% per annum. Construction is completed on 15/6/18. He has let out the property at a monthly rent of rupees 30,000, and he has paid municipal taxes of 20,000 at a rate of 10% of municipal value, and entire loan is outstanding. You are required to compute income from house property. Now, since the property is constructed during the mid of the year, therefore, we have to take the rentals accordingly. It is 30,000 into 9.5. And the municipal taxes so paid will be allowed as deduction, and interest on borrowed capital will be admissible as deduction, including the pre-construction period interest. That is, pre-construction period is 1/4/16 to 31/3/2018. That is pre-construction period interest. The same is allowed in 5 equal installments, and current year interest is rupees 60,000. So hence the income from house property here will be 1,01,500. It is 1,01,500 is the answer. Then Mrs. Karina, wife of Mr. Sham, is a partner in a firm. Her capital contribution is 7 lakhs as on 1/4/18, including 3.5 lakh out of Sham, gifted by Sham. On 10/4/18, she has further invested 2 lakh as gifts received from Sham. So as you are aware of the clubbing formula, the firm has paid interest of 50,000 and share of profit 60,000. Share of profit from firm is exempt from tax. Interest will be clubbed in hands of Mr. Sham to the extent whatever investments have been made as on the first day of the previous year, out of which how much is a transferred assets investment. That is, total interest is 50,000 she has received, and value of the investment made on the first day of the previous year out of transferred asset is 3,50,000, and total investment is rupees 7 lakhs. Therefore, only 25,000 will be clubbed in hands of Mr. Sham. So, share of profit is exempt from tax. 25,000 will be includable in income of Sham, and interest of what? 25,000 to the extent will be includable in Karina. Now next is Mohit has purchased an asset of our scientific research on 2008-9 for 30 lakhs, and during the previous year 18-19 the said asset was used for scientific research. It ceased to be used for say scientific research in 18-19. And profit from business before depreciation is 10 lakhs. WDV of the block of asset is 15%, on 1/4/18 is 20 lakhs. So in case if the asset is used for scientific research, now it ceases to be used for scientific research, and the same is subsequently used for the purpose of business, then in that particular circumstance, that will be added in the block of the asset. But here they are providing that it has been sold without having been used for the purpose of the business. So in case your business profits are how much prior to the allowance of depreciation is 10 lakhs. So we'll be allowed the depreciation on the block of the asset, that is 10 lakh. Depreciation will be allowed 3 lakh rupees. And in case the asset which has been used for scientific research is sold without having been used for the purpose of business, to the extent of the deduction which has been allowed for the purpose of under section 35(1)(4), that is here the entire cost of the asset will be deductible. Therefore, as per the provisions of section 41(3), the same will be treated as profits chargeable to tax, and capital gains will be computed separately on sale of such assets. The asset is sold for 65 lakh rupees. Capital gains will be computed separately on the same. The cost of the asset was 30 lakh rupees acquired in 8-9. We'll be using the index of the 8-9, and index of the year of transfer is 280. So this will be the capital gains. So what you are required to find out is the total income. The total income will be 40 lakh 68,610. The next question was relating to depreciation. As you are aware that block of asset beginning here it is 25 lakh rupees. Additions were made of plant C. 5 lakh is paid in cash and 10 lakh has been paid through account paycheck. So to the extent of 5 lakh, the same will not form the part of the cost. 10 lakh will form the part of the cost here. And plan D is also acquired. Here 7 lakh 20,000 has been paid through RTGS. So 7 lakh 20,000 will form the part of the cost. And asset has been sold for 6 lakh rupees. The same will be reduced. On this WDV, on this 720, depreciation will be admissible at half of the block rate. And on remaining, it will be admissible at full rate, that is 15%. So likewise, we are required to find out the admissible depreciation. So admissible depreciation is rupees 4,89,000. The next question is G Limited is engaged in the business of growing and manufacturing tea in India. For the previous year ending 31/3/19, its composite business profits before allowing deduction on 33 AB is 60 lakh rupees. So 60 lakh was before allowing deduction, and they have deposited a sum of 11 lakh rupees in tea development account. So 11 lakh rupees has been deposited in TDA account on before the due date of what? Furnishing the uh, within 6 months or on or before due date of furnishing the return of income. So 60%, that is 40% of rupees 60 lakhs or 11 lakh, which was less, will be allowed as deduction while computing the business income. Whatever brought forward loss of 14 lakh rupees is there, the same shall be what? Deductible. So here, from 60 lakh rupees, 11 lakh rupees will be allowed as deduction. Then 60% is the agricultural income, 40% is the business income. So business income as a brought forward business loss will be allowed as deduction, and the remaining will be the taxable business income. So the taxable business income works out to be rupees 5,60,000 in such a case. Then RP Limited purchased a plant of rupees 60 lakhs, depreciation rate 15% on 26/18. Then before commencement of the commercial production, expenses of 55,000 were incurred by RP Limited for trial run. So in case of any test run or trial run expenditure has been incurred, the same are to be capitalized before the commercial production, as has been given in para 8 of the ICDS 5. So the option here will be what? The expenditure of rupees 55,000 is required to be capitalized as commercial production has not commenced. The next is relating to what? We have to compute presumptive income under 44 ADA. As you're aware, in case if you're going for 44 ADA and you have to compute the presumptive income, 50% of the profits will be regarded as presumptive income provided your professional receipts does not exceed rupees 50 lakhs. So here the professional receipts is rupees 48 lakhs. So 50% of rupees 48 lakhs will be 24 lakh. All deductions will be allowed, deemed to have been allowed, 30 to 38, including whatever, say, remuneration to partners is there, interest to partners is there, and the amount of loss, which the firm is carrying forward will be allowed because the same falls under section 72. So here the total income will be 23 lakh 50,000 rupees. This is the total income. They are asking for the total income 23 lakh 50,000 rupees. Then next is companies engaged in the manufacturing pharmaceutical products commences business on 1/4/18. Pharmaceutical products company assessees there will be entitled for deduction under section 35(2)(ab) in case of scientific research. 2 lakh annually has been incurred on salaries and purchase of materials used for scientific research. The same will be allowed under 35(1)(1), whatever expenditure has been incurred prior to the commencement of the business. It's 15/16, 16/17, and 17/18. Within a period of 3 years prior to the commencement of business, deduction will be allowed under section 3511, and 1819 it will be allowed under 352AB. Capital expenditure on plant and machinery, the same will be allowed as deduction under 352AB. So here under 352AB you will be allowed a weighted deduction of 1.5 times, and 3511 will be allowed 100% of the expenditure will be allowed as deduction. So this way the amount deductible will be rupees 14,25,000. Then in case if a trade association is there, as per the provisions of section 44A, it will be allowed deduction on account of expenditure which has been incurred for members. And the maximum amount of deduction that will be allowed is, that is, if the general expenditure incurred exceeds the receipts, then there's a deficiency. The deficiency will be allowed to the extent of 50% of total income before allowing such deficiency. So here the income is 80 lakh rupees, deficiency amount is 75,000 rupees, and this is business income, and total income before allowing deficiency is 140. So 50% of 140, that is 70,000, will be deductible under section 44A. The next question is, XYZ Limited has purchased a machine on 1/4/18 for rupees 10 crores by availing 70% facility from bank. The machine was put to use on effective production on 1st February 19. Interest on loan is charged at rate of 12% per annum. The loan amount is outstanding on 31/3/19. Interest for financial year 31/3/19 is paid on 31/3/19. So whatever interest relates to the period prior to the asset is put to use, the same is here capitalized. So you are required to compute the depreciation admissible. So the machine cost is rupees 10 crores. Interest on borrowed capital before the asset is, say, put to use will be capitalized, and after the asset is put to use will be allowed as a revenue expenditure. So machine cost works out to be 10 crore 70 lakhs, on which depreciation shall be admissible at half rate, that is 7.5% of rupees 10 crore 70 lakhs, 80 lakh 25,000, and additional depreciation will be admissible at rate of the 10% of the actual cost. So total admissible depreciation will be this much amount. Then here next question was relating to what? Miss R sells a plot of land on 21/11/18 for rupees 50 lakhs. She has inherited her plot from a grandfather on 1/4/10. Grandfather has acquired the same for 2 lakh rupees. Fair market value they have provided is 8 lakh rupees. And sales consideration is 1.5%. So here the full value of consideration is 50 lakhs, less expenses on transfer, 1.5% of the sales consideration, less indexed cost of acquisition. The cost to the previous owner will become his cost. There is a fair market value as on 1/4/2001, 8 lakhs into 280 divided by 100. So this will be the long-term capital gains. Next is Mr. X has sold his land for a consideration of 25 lakhs to Mr. Y. Mr. Y has paid stamp duty of 2,62,500 at rate of 10% of stamp value. Fair market value of the property on date of transfer is 25,50,000. So here we have to see the stamp duty value, that is 26,25,000, is if it exceeds 105% of the actual consideration, that is 105% of 25 lakh rupees. If it exceeds the same, then we have to take the SDV. Since it does not exceed 105% of the actual consideration, therefore the actual consideration here will become what? The full value of consideration. The full value of consideration in this case will be rupees 25 lakhs. Then in the next question, there was dividends from various companies. Business income has been 80 lakh rupees, and we were required to compute the total income. Now first is from shares of DEF Inc, a foreign company in which it holds 25% nominal wealth. This is dividend from foreign company. The same will be chargeable to tax, and whatever expenditure has been incurred to earn such income, the same will be deductible here. From 1,60,000 rupees, you will be getting a deduction of 8,000 rupees. and remaining amount will be taxable. And in this is a specified company, specified foreign company, we won't be getting any expenditure allowance. It will be chargeable to tax at rate of concessional rate of tax. Therefore, this dividend is taxable. An Indian company dividend is what? Exempt. Therefore, income from other sources is 5,22,000 rupees. PGBP income is 80 lakh rupees. Total income will be 85,22,000 rupees. Then next is Mr. Sharma asks you to compute his taxable income from the following transactions which took place with his friends. Cash gift has been received from two friends, 32,000 each. The same will be taxable under 56(2)(10). Two plot of land gifted by Mr. B and Mr. C whose stamp duty value is 3,50,000. The one plot will be taxable. The other one will not be taxable since SDV does not exceed rupees 50 lakhs. 50,000, sorry. And Mr. E has purchased a residential house of 6 lakh rupees from Mr. D, which was not registered, but the present stamp duty value is 7 lakh 50,000. The difference between the stamp duty value, that is 7 lakh 50,000 minus 6 lakhs, it exceeds 5% of the consideration, so paid 30,000 or rupees 50,000, which is higher. Hence, this amount will be what? Taxable. So this is taxable. One plot is taxable where SDV exceeds 50,000 rupees and cash gift is also taxable. So the total income will be 5,64,000 rupees. Then on 5/4/18, A Private Limited issued 20,000 shares at a premium of rupees 50 per share. The face value of share is 10 and the fair market value is rupees 30 per share. Since the issue price exceeds the fair market value of shares, whatever amount is received by the company by way of issue of shares to a resident, the same will be chargeable to tax. Now here, X was not in India from the date of issue till 2/9/18, but he has came on 3/9/18. So here, this amount will be chargeable to tax as income from other sources in hands of A Private Limited, and the amount to be taxable will be rupees 10 per share, that is rupees 2 lakh. Then Mr. Y gives 12.75% debentures worth rupees 10 lakhs to Mrs. X. Y for Mr. X brother. These are cross transfers, and Mr. X has gifted a flat to Mrs. Y. The rental income is earned by the spouse, that is Mrs. Y. The same will be clubbed in the hands of Mrs. Y. And interest income which is earned by Mrs. X will be clubbed in hands of Mr. X. So here they are saying interest income will be clubbed in hands of Mr. X, and the rental income will be clubbed in hands of Mr. Y. In case of cross transfers, whatever income that arises to the spouse is clubbed in the hands of that individual. Our own spouse we have to see, not other spouse. So income which accrues to the spouse is to be clubbed. Now the question number second, we are discussing the mock test paper. Now question number second, we'll be discussing one and one every point here. The question number second was, देखिए, Mr. Parikh Hospitality Limited is engaged in the business of running hotels of 3-star category. The company's statement of profit and loss for the year ending 31st March 2019 shows a net profit of rupees क्या 152 lakhs. So net profit is rupees 152 lakhs. Then first is payment of 0.25 lakhs and 0.30 lakhs in cash on 3rd December and 10th December respectively for purchase of crab, lobsters and squids to Mr. Raja Fisherman. So it is an exception to Rule 6DD, whatever has been provided in Rule 6DD. If you make payment to a fisherman for purchase of fish produce, then the same will be allowed even if the cash payment exceeds rupees 10,000. So here in a day. But other one payment is to a middleman. So in this case, amount to be disallowed will be rupees 30,000 rupees on account of the middleman. और ये आपको बताना पड़ेगा कि whatever payments have been made to a fisherman, the same will be allowed. Then next one is contribution towards what? Employees pension scheme. As you are aware, under 36(1)(5)(4)(a), the employer's contribution to pension scheme is deductible to the extent of 10% of salary. Salary means basic salary and dearness allowance. You have to write the same. And here they have contributed 3 lakh rupees at rate of 12% of salary. So 10% will be allowed and 2% will be what? Disallowed. So 3 lakhs into 2% divided by 12%, that is 50,000. The same will be disallowed. Then is 6,50,000 to transport of various materials procured by one of the hotels of measures Bansal Transport without deducting tax at source. Now here Bansal Transport does not own more than 10 goods carriages during the previous year and it's given their PAN. So in case of a GTA who owns 10 or less than 10 goods carriages at any time during the previous year and it gives his permanent account number, then no tax is required to be deducted at source. Hence, the said payment will be allowed as deduction. Then profit of rupees 12 lakhs on sale of plot of land to Avimanyu Limited, a domestic company. Entire share capital is held by the SSC company. The plot was acquired by Parikh Hospitality Limited on 1st June 17. So as you are aware that in case if there is a transfer amongst holding to subsidiary company and transferee company is an Indian company, capital asset is transferred, then capital gains won't arise. It won't be regarded as transfer by virtue of the provisions of section 47(4). Now this 12 lakh rupees has been credited to the profit and loss account. Your statement of profit and loss, it contains 12 lakh rupees. Hence this 12 lakh rupees will be what? Not chargeable to tax. Here, and it may be taxable under capital gains, but as I already told you, since the transfer is to an Indian company and that is our subsidiary, capital gains won't be chargeable to tax in such a case. So in capital gains also, we have to write that same won't be taxable. Here the amount will be say nil. It won't be taxable. Then next is payment to contribution of 2,50,000 to Indian Institute of Technology with a specific direction that it will be used for the approved program. So in case if you pay any amount to Indian Institute of Technology with a specific direction, then 1.5 times of the sum so paid will be allowed as deduction under section 35(2)(a). So whatever amount has been paid, here 2,50,000 has been paid to Indian Institute of Technology, the same will be added back and rupees 1.75 times will be what? Allowed as deduction. It will be deductible. Then next is what? Payment to non-resident of 5 lakh without deduction tax at source on fees for technical services in respect of project in Japan. So here the entire income of non-resident accrues or arises outside India. Since the income accrues and arises outside India, there is no requirement of tax deduction at source. And since the same has been paid without deducting tax at source, no disallowance will be made in such a case. Then fees for 1 lakh on account of professional services paid to independent directors. Under 194J, tax has not been deducted at source. So the same will be fees paid to independent directors without deducting tax at source. It will be here disallowed. The same will be disallowed at rate of 30%. Depreciation charge is 10 lakh rupees. Whatever depreciation is charged, the same will be added back. Besides this, dividend from foreign company is 5 lakh rupees. Whatever dividend is from foreign company, it will be reduced here and will be chargeable to tax as income from other sources. 10 lakhs being an additional compensation received from state government pursuant to an interim order. So whatever 10 lakh is additional compensation, the same will be reduced and will be chargeable to tax under the head capital gains when the compensation is say finalized. Interim award won't be taxable. Provision for gratuity is 5 lakh. Actual gratuity paid is 1 lakh 50,000 rupees. So provision for gratuity will be added back and whatever actual gratuity is there, the same will be allowed as deduction. So the amount deductible will be 5 lakh will be added back and 1,50,000 will be deductible. Then miscellaneous expenditure includes 7,50,000 on use of railway assets. So expenditure on use of railway assets will be disallowed since the payment has not been made on or before the due date of furnishing the return of income. Besides this, it has been provided that as per additional information is there, as a corporate debt restructuring, the bank has covered unpaid interest of rupees 10 lakhs, converted it into a new loan, and one installment of 2 lakh is paid in March 19. So this 2 lakh converted loan, it is in the interest which has been converted into loan, the same will be allowed as deduction. So it will be deductible to the extent of rupees 2 lakh. And besides this, depreciation as per IT, the same will be reduced 15 lakh rupees. And company has received bill of 2 lakh in March 18, and the same has been omitted in March. Bill is paid in April 18, and necessary entry has been made. The expenses for which payment will be made during the year, the same which was omitted earlier, the same is allowed. So this way, our adjustments will be made in PGBP. This will be the business income. Then capital gains we have already discussed. Nothing will be taxable both on that account, on this transfer to subsidiary as well as award, since the same has not been finalized. And income from other sources for income, this will be taxable, and the total income will be 1 crore 31 lakh 85,000 rupees. Then the next question is question number 3. SS Private Limited, a domestic Indian company, has two undertakings engaged in manufacture of cement steel, and there was a demerger. Net book value of assets of SS Limited is before demerger is 40 crores. Net book value of assets transferred to RV Private Limited is 10 crores. Demerger was made in January 19, or shareholder for each equity share they issued 2 shares of the resulting company. One NK is held 25,000 shares, so he will be given 50,000 shares, and he has received 50,000 shares, and he has sold all the shares for 8 lakh rupees. In this background, we have to compute what does a transaction of demerger attract income tax liability in hands of SS Private Limited, or say RV Private Limited. So in case if any assets are transferred by demerged company to resulting company in pursuance of demerger, it is not regarded as transfer. So here capital gains won't arise in hands of what? SS Private Limited. Similarly, in hands of RV Private Limited also, no taxation will arise. State the conditions in brief which has been discussed which are satisfied under the Act for a demerger. So you have to write section 219 AA. All the properties of the undertaking of the demerged company becomes the property of the resulting company of the undertakings which have been transferred by way of demerger. All assets, all liabilities relatable to undertaking being transferred by demerged company immediately before demerger becomes the liability of the resulting company, and properties and liabilities of the undertakings are transferred at the values appearing in the books. Then the resulting company issues consideration of demerger in form of shares to the shareholders of the demerged company, and the shareholders not holding not less than 75% of the value of the shares of demerged company becomes the shareholders of the resulting company. And transfer of undertaking is ongoing concern, and other conditions which have been laid down by the government are fulfilled. So you have to write that. Then question number 3 was compute the capital gains that would arise in hands of NK. So when any shareholder of a resulting company, demerged company, receives any shares in a resulting company, the same is not regarded as transfer, and hence no capital gains will arise on receipt of shares of the resulting company. When resulting company's shares are sold, then capital gains arises. Then compute capital gains that would arise on sale of shares of RV Private Limited. So it sold the same for rupees 8 lakhs. Then what is the cost of acquisition of the shares of resulting company in pursuance of demerger? So whatever is the cost of shares of the demerged company before demerger into net book value of assets transferred to resulting company upon kya? Net worth of the demerged company before such demerger. So basically, cost of action of the shares of resulting company will be cost of shares of demerged company into net book value of the assets transferred to resulting company into kya? Divided by the net worth of the demerged company before demerger. So here he has acquired those shares for 6 lakh rupees. 10 crores of the assets have been transferred to resulting company, and net book value of assets, net worth was rupees 40 crores, so cost will be rupees 1,50,000. And the period of holding of the shares of the demerged company will be included here. So indexation will be from 105, and this way you have to compute the capital gains. And is he eligible for any exemptions? So in case if he purchases a say any residential house, then the capital gains can be exempt under 54F, or he can buy the units. He can claim exemption under 54EE. Next question is regarding discuss the liability of the following receipts during the previous year ending 31/3/19 in hands of Ms. Jyoti under Income Tax Act. Gift of 60,000 cash from her friends from her father's sister on her birthday. So father's sister comes under the ambit of relative, brother or sister of either of the parents of the individual. The same comes under the ambit of relative, and hence taxability will not arise in such a case. Then acquired vacant land from grandfather's younger brother. The stamp duty value is rupees 3 lakhs, and he has paid consideration of 2 lakhs. The grandfather's younger brother is not coming under the ambit of relative, and hence taxability will arise. And here, since the consideration paid and the stamp duty value difference exceeds 5% of the consideration, or rupees 50,000, which is higher, therefore taxability will arise. It will be chargeable to tax under income from other sources. Car is not coming under the ambit of asset, movable asset, as defined under section 56(2)(10), hence won't be taxable. Interest on enhanced compensation will be chargeable to tax, rupees 3,50,000. From such enhanced compensation, deduction will be allowed ad hoc 50% of the same, that is 1,75,000. Then receipt cash gift of 15,000 each from her 3 friends, since it does not exceed rupees 50,000, hence it won't be what? Chargeable to tax. Likewise, her income from other sources would be 2,75,000 rupees. The next question is 4A. Mr. Ram has a salary income of computed 4,50,000. Arjun, minor son, is getting agricultural income of 1,20,000. As you are aware that agricultural income will be clubbed for rate purposes. Ram contention is that agricultural income is exempt. Though the agricultural income is exempt, whatever income is earned by a minor child on agricultural income which has been earned by a minor child will be clubbed for determining tax liability of Mr. Ram for purpose of rate. Agricultural income plus other income, tax on agricultural income plus other income, then tax on agriculture income plus basic exemption limit. For then on that differential tax will be have to be paid. Then next question is in relation to amalgamation. In case of amalgamation, the depreciation is divided between the amalgamating company and the amalgamated company on the basis of number of days. So here the WDV of the amalgamating company becomes the WDV on which depreciation will be calculated, and the same will be divided in the ratio of number of days for which the assets are used by the amalgamating company and by the amalgamated company. Then next is Sachin settled 1/4 share of property under a trust for education and maintenance of his minor daughter, Pallavi. Under the terms of trust deed, the income accruing to trust after meeting the expenses of maintenance of education of Pallavi will be accumulated and paid over to her on attaining majority. Only that income that accrues or arises to a minor child during the minority will be clubbed in such individual's income. In this case, since the income won't accrue or arise to minor child during minority, hence clubbing won't be attracted. But to the extent of the education expenses and maintenance expenses which has been met by the trust, the same will be clubbed in hands of Mr. Sachin. If income does not accrue to the minor during minority, clubbing provisions won't be attracted to the extent of the education and maintenance expenses. The same will be clubbed, and from the clubbed income, exemption is allowed to the extent of 1500 rupees per child. Next question was ki rental income is property is 3 lakh, standard rent is 250, fair rent is 280. The 3 lakh will be the gross annual value. Then whatever municipal taxes have been paid, including arrears, the same will be deductible. The same will be what? Deductible here. That is a net annual value. And 30% of the net annual value will be allowed as standard deduction. That is standard deduction. 30% of the NAV. Interest on borrowed capital will also be deductible. Besides this, whatever arrears of rent has been received after deducting 30%, ये हो जाएगा आपका taxable income from house property आ जाएगी. उसके अलावा they have given that Singh's father has acquired a residential house in 2 lakh and thereafter gifted to Singh, and the property has been sold for rupees 25 lakhs, whereas the stamp duty value is 30 lakh rupees. The stamp duty value will be regarded as full value of consideration, and here the cost to previous owner, that is 2 lakh rupees, will become his cost. Whenever the previous owner has acquired the property, that is 1112, that will be taken into 280. As per Manjulal J. Shah's case, that is index cost of acquisition. Besides this, he has purchased 2 adjacent flats. They will be regarded as one house because they are adjacent, and he has been made as one unit. So this will be deductible 54, and 10 lakh rupees has been invested in NHAI bonds. So he will get the benefit of exemption of section 54 EC to the extent of rupees 10 lakhs. So here, this way, the resultant sum will be the capital gains and loss of house property will be adjusted to work out the total income. So here you have to see that the working notes are very, very important, and the marking scheme is this. तो आपको इस हिसाब से क्या है, you have to write your answers, write your working notes, चाहे वो आप separately लिखें, चाहे वो क्वेश्चन के अंदर स्पेसिफिकली मार्क करके बताएं कि ये हमारा वर्किंग नोट है. Because if we see that this is a question, say around about of 16 marks, so for each and every working note they are giving half marks, and for the calculation part they are giving half mark. So this way you have to write your papers. Working note are very important, और आप MCQs की भी ज़्यादा से ज़्यादा प्रैक्टिस करें, because MCQs are also very very important. If it is a 30 marks weight, तो बहुत, अगर आपके 25 तक भी सही आ जाते हैं, तो it's very easy to pass the exam. Thank you very much.